Namaste to all. I welcome you all on this yet another an interesting panel discussion today hosted by ICI, the Accounting Standard Board. Today's topic, a very interesting topic and very important topic, which is relation to the revenue recognition. If we talk about revenue recognition, that is actually one of the very important, I would say not standard, but very important point for preparation of the books of accounts and finalization of the accounts. And based upon that, lot of things is dependent, including, I would say, income tax, GST, all other matters. Though there may be certain carve-outs by the revenue departments to tax directly or indirectly, but the accounting thereof is very important. And to discuss the various issues on recognition of revenue, we have got an excellent panel today. We have got CA Mohan R. Laviji, who has got more than 30 years of experience, which has got industry experience as well as the in practice experience, who has been a regular contributor and an author of various aspects of IFRS and Ind AS, and has been regularly contributing to the institute. I welcome you, Lavi sir.
Thank you, sir.
And thanks for accepting the invite to be a panelist out here.
Anytime.
Another panelist which you have is CA Archana Bhutani ji. Again, she has got a very vast experience, and she's a partner of one of the big fours. And her forte is basically accounting standards and Ind AS. More Ind AS, less of accounting standards, to be very frank. But yes, her concepts are so clear that many of the time, our institute, I would say she has been a regular contributor to the institute, whether it is the Accounting Standard Board, whether it's EAC, she is a co-opted member of EAC and ASB several times. And whenever we find that, okay, we need to discussion one-to-one, we trouble her to take her views thereon. Thank you, Archana ji, for accepting to join this very interesting discussion on the revenue recognition.
Pleasure to be here. Thank you so much for inviting. Thank you.
And to moderate these two star words, we have none other than C. Alok Devraj ji. Many of us may not have heard him earlier, but yes, he is a frequent speaker at Aurangabad. He is Aurangabad based, and he has a great interest in the Ind AS and the accounting standards. So I welcome you, Alok Devraj ji, and
thank you very much, sir.
So let us keep our floor open, and I'll request Alok Devraj ji to please start the deliberations.
Okay, thank you very much, sir. Namaste and very good evening to everyone. I would start with a quote of Abraham Lincoln. Give me 6 hours to chop down a tree, and I will spend the first 4 sharpening the axe. The webinars conducted by ASB are to sharpen our skills and definitely reduce our time to form an opinion. My sincere thanks to Chairman of ASB, Pramod sir, and the Committee of ASB ICI for giving me the esteemed opportunity to moderate this webinar with a distinguished panelist. Today, we are going to discuss about the critical accounting aspects of revenue recognition. The company and external stakeholders focus on revenue as a key performance indicator. In today's complex business transactions, it is very difficult to book the correct revenue without any estimates, assumptions, and judgments. Hence, to solve our difficulties, we have 2 learned panelists with us. I welcome Mohan sir and Archana ma'am. The topic is very vast, and we will try to cover our level best. I request all participants to pose their queries. Panelists will address your queries at the end of the sessions. So, let me start the sessions with Mohan ji. We would like to know what are the accounting standards, guidance notes, and the reference material available to be referred for the revenue recognition.
Yeah, thank you, Alok ji. So thank you, Pramod ji, also for calling me again. I think this is the second time we're doing 115, webinar on 115. And of course, when Archana madam is there, I don't think I need to be a panelist. But then Pramod ji ne bola to aana hi padega humko, right? So it's been a pleasure to be a part of the institute here. I just want to, before I answer your question, Alokji, I'll just give a little bit of a background. This standard, because it involves a lot of assumptions and estimates, judgments, and all those things. Many of the responses we give are based on what we hear your questions to be, right? What we would hear your questions to be. So there could be, further clarifications required on a few of those questions. I'm sure Arjuna will agree with me. But to the extent possible, we'll definitely try to solve the questions which come from you and also from the participants to the extent which is possible here. Okay, now you said you asked me what is the material which has to be referred to for Ind AS. My first point of reference will always be the standard itself. You'll first have to go to the standard itself, right? So because if you looked at 115, it is slightly more detailed standard. It's got about 67 pages in length, and as compared to 11 and 18, Ind AS 11 and 18, it's got a little bit more clarity, shall I say, in terms of expanding on the scope of revenue, the performance obligations, and all those things here. Because basically, Ind AS 11 was only on construction contracts, and 18 was for this interest, royalty, dividend, sale of products, and rendering of services and all those things. But this is a slightly more detailed standard. So my first reference point will always be the standard per se. It's not too difficult to read. But I would also take this opportunity to encourage the participants to read out this educational material given by the ICAI on Ind AS 115. As compared to the IFRS had some illustrative examples as a part of the standard. Because of some, I think copyright or patent issues, we could not reproduce them in our standard. But the education material of the ICAI, it's got about 78 questions on various aspects of 115, which is basically what is covered in the illustrative examples also. So I would always encourage first reading of the bare standard and then reading the illustrative examples or reading the educational material which has been given by the ICAI. I think these would be my two reference points. For the accounting policies, I would always advise to go to annual reports of companies and look at the disclosure requirements there. I think later on Archana is covering the disclosure aspect. So I think if you look at the disclosure requirements given in the annual reports of companies, they are pretty detailed. So I think I would look at it from this point of view, looking at it from all the 3 points of view for getting a good grip on the 115.
Okay, thank you, Mohanji.
No, here I would like to add 1 or 2 points out here.
Yes, sir.
It is not merely 115. If I talk about the Indian entities, it is not merely Ind AS. Because the participants are not only for the Ind AS, they're for the AS also. So if I talk about around 15 lakh companies and around another 30 lakhs proprietorship partnerships tax audits, so only 28,000 are complying with Ind AS. All others are complying with the AS. So under the AS also, there is AS 7, AS 9. AS 7 is for construction, AS 9 is for revenue.
Right.
And for ICDS again, which is applicable both for the companies and non-companies. We have got ICDS 3 and ICDS 4. ICDS 3 is for construction contracts and ICDS 4 is for the revenue recognition. So we'll try and see that when we discuss from all the angles and not merely in depth.
Sure. Point taken. Yeah.
Thank you.
Okay. In addition to that, there is even guidance note available for real estate businesses as well, sir. So that's where, if we possible, we will take that questions as well. So continue. Thank you, Mohanji. Continuing with you, what do you mean by the revenue? Whether it is defined in any AS?
See, as the first, I'll come in reverse order. I'll first finish Ind AS and then come to the AS point of view.
Okay.
Ind AS 115 defines revenue to be any income which is arising from the entity's ordinary activities. It has been defined specifically in Ind AS 115. In the definition section of 115, they've given us a clear definition of what is revenue. Income which is arising from the ordinary activities of an enterprise. AS tells us what are the types of revenue. As I told you, sale of goods, sale of products, rendering of services, interest, royalties, and dividends. It does not specifically tell us what is revenue, but it tells us how to recognize revenue against each of those individual items per se. So I think that is a small difference between your AS as far as your Ind AS is concerned. Now, when we talk about ordinary activities, Alokji, it does not mean to say that the gamut of or the scope of 115 is slightly more. It's slightly more than what it would be under a normal AS, because we are not trying to restrict ourselves only to those 5 categories which were given by your AS, right? So it could be, something which is a little bit larger. For example, I just put one activity out there. The onboarding services which a company like Amazon gets from, for their vendors, in which they take a particular fee from the vendors for advertising and also pay that fee to, the advertising agency. Whether that revenue, whether the fees from these onboarded vendors, whether it should be called revenue is something we'll have to discuss about. Because if you look at the definition, it will probably fall into the category of revenue here. So the point I'm trying to make is it's slightly more wider and clearly defined in Ind AS 115. The scope is a little bit more larger than what it is in AS 9 and AS.
Okay, thank you, Mohanji. Whether the AS and Ind AS are applicable for all types of the contracts, or are there any exceptions to that?
You're talking about the scope of the standard, right?
Yes.
So Ind AS, again, generally the contract itself is entitled as revenue from contracts with customers. So it means wherever there is a contract with the customer, it would we'll have to apply Ind AS 115. But the scope, it scopes out a few things. For example, it scopes out insurance contracts because it's covered by a separate standard by itself. There is some income which could arise from a leasing contract, for which you have to fall back upon Ind AS 117. There are certain items like, for example, financial instruments, effective interest rate or the interest recognition on financial instruments, that would come in from Ind AS 109. So these 3 are being scoped out. Also, what 115 specifically says is that non-monetary transactions of entities engaged in the same line of business, that also is out of the scope of a contract. For example, 2 advertising agencies who sort of, get into a barter transaction or a transaction with each other for the purpose of, a particular sale and purchase for the other entity, that also would be out of the scope of, Ind AS 115. That is only if it is a non-monetary transaction for entities in the same level of business. So basically, there are 4 scope outs which have been given in your Ind AS 115 standard here. So these would, because the reason being that it is covered by those specific standards again there.
Are the same exceptions are in AS 9 as well, sir?
No, but AS 9 does not have these because we don't have such detailed exceptions given in AS 9 there. But again, as I told you, it goes only for specific revenue, recognition principles there or types of revenue.
Okay, thank you, Mohanji. Now move on to the Archanaji. What are the basic principles governing the AS and Ind AS? And what are the key differences between AS and Ind AS?
Okay. First of all, thank you for being part of this session, and it's a pleasure to share the panel with such senior people. It's really looking forward to the discussion today. In terms of the general principles, I think if I can just use the comparison bit to kind of explain. If you look at AS 9, we had 2 standards. You had AS 7 and AS 9. AS 7 dealt with or deals with construction contracts, and you've got AS 9, which deals with sale of goods, services, and your interest, dividend, etc. Now, effectively, you've got 2 different models. When you look at the concept, the way AS 9 is, and when you look at AS 7, the models are very different. Now, even though AS 9 and AS 7, when you look at AS 9 for services, both of them refer to percentage completion method. The way the percentage completion method works in AS 7 and in AS 9, they're again very different. So the point I'm trying to make is that under the AS framework, you've got more than one standard. There are different models which work for different types of revenue transactions. You've got a different model for sale of goods, maybe for services, there's another one, construction services, there's another one, and so on. But when you come to Ind AS puts all of this together in one standard and it gives you a single model. So you've got a single model. It's a 5-step model. Whereas in AS, you don't really have any steps per se, but I'm not trying to make it a rule-based, but generally there is a structured single model in Ind AS to deal with all revenue contracts. So in a way, it is no longer dependent on the nature, the kind of nature of transaction, whether it's a good or a service. So you'll follow the same model. In terms of principles, of course, both these standards are intending to see when to recognize revenue and how much revenue to recognize and what disclosure. So any standard, if you look at it, has principles for recognition, measurement, and disclosure. So same is case here: when to recognize revenue, how much revenue to recognize, and what are the disclosures. Now, of course, when you get into the details, there are significant differences conceptually. And when I say differences, some of them could also be clarificatory. So Ind AS 115 obviously builds on the experiences that we had in terms of the implementation of the earlier standards. The earlier standard was very brief, short, if you see, very limited in that context. And with the complexity of transactions increasing, e-commerce and various other types that we've seen, the standard obviously is a more elaborate one in that sense to deal with the changing business scenarios as well. Like I said, there are significant differences. And if I was to kind of just start off, like I said, there is a 5-step model, which in a way gives you, which this model specifies that revenue should be recognized when the entity transfers control of goods and services to customer at the amount to which the entity expects to be entitled. Now, if you see, what I mentioned refers to control. Okay, this is Ind AS 115. AS 9 had this concept of transfer of risk and reward. So there you recognize revenue on transfer of risk and rewards. Here you're recognizing revenue on transfer of control. Now, would these two be very different, or is it that we expect largely, the timing to be similar? I think in many cases it will be similar, but I'm just highlighting conceptually there is a difference between the two. Similarly, if you see what I mentioned, I spoke about recognition of revenue at the amount to which the entity expects to be entitled. So it is clearly not your invoiced revenue, etc., but it refers to amount which you expect. Now, I'll explain through an example. Let me just take that right now as to how do you interpret amount which an entity expects to be entitled. So let's say I make a sale of 100. My invoice amount is 100, but I have a good relationship with this customer, and I know because of my relationship, invariably, I will give, let's say, 5% discount. Or it could be another case that maybe it's a new customer, but for strategic reasons, I want to make sure I build a relationship. And I know though I'm invoicing 100, I will end up giving a 5% discount, right? So while my invoice is 100, the amount I expect to be entitled while making my negotiations, while entering into the contract, if I expected that I will pass on a price concession, a discount, and I will be entitled only to 95, that would be the revenue. So again, like I said, there are many nuances when you come to Ind AS 115 in terms of how recognition happens. So like I said, 5-step model, reference to control in terms of point of recognition, that the control should have transferred. In terms of measurement, it talks about amount to which an entity expects to be entitled. Now, when you look at this single model, what does this single model result in? It will either result in recognition of revenue over time or at a point of time. So there are only two outcomes: over time, at a point of time, and depending upon when the control is transferred, you will either recognize it at a point or over time. Now, if you look at the title of the standard itself, the title of the standard of Ind AS 115 is revenue from contracts with customers. So two things become very relevant when you come to Ind AS 115 is the definition of contract and customer. There is reference to the customer. So these two terms are not there if you look at the title of the standard, AS 9 just said revenue recognition. So now what is a contract? Who is my customer becomes very important. And we'll discuss this during the course as to how can, you may just think, what is the complexity in identifying who my customer is, but there can be situations wherein just identifying who the customer can be a challenge. Why am I referring to the word contract? Because, the recognition of revenue, or let me forget recognition, you don't even step into Ind AS 115 till the time the definition of contract is met. So if you've got a contract, if you've got a contract until the time that contract does not meet the definition as per Ind AS 115, you will not even account for that contract as per the standard. Now, why is this contract definition so important? So if you look at the elements, sorry, I'm getting into a bit of detail here, but if you look at the elements, one of the elements of the contract, the criteria for contract definition being met, is that collection of consideration is probable. Okay. Now, if you look at AS9, in AS9 also we looked at credit risk, but we looked at credit risk at the time of measurement. We did not say, do I need to recognize? You didn't look at credit risk at the time of for determining the timing of revenue recognition. It was more about measurement. So let's say if my contract is 100, but I believe I will not collect 20, I will measure my revenue at 80. But here, Ind AS 115, let's say the revenue which I expect to be entitled to. I'm using that term which I just spoke about earlier. Revenue which I expect to be entitled to is 100. Okay, it may not be the invoice amount. I'm not getting into that, but the revenue which I expect to be entitled to is 100. And because of the credit issue, the ability of the counterparty to make the payment, I feel I may not be able to get 100. Actually, then you cannot do revenue recognition under Ind AS 115. So you don't even start the getting into the model. So there is the contract criteria is met. I mean, there is a contract criteria. One of the conditions is that collection of consideration is probable. So collectability in Ind AS 115 is a gating question, whereas under AS9 it was not a gating question, but it was more into measurement. So the intent of Ind AS 115 to bring it as a gating criteria is to prevent entities from applying the revenue model to problematic contracts, recognizing revenue in the initial year and then just recognizing, impairment losses. So, you do grossing up, you do revenue recognition, and then you do an impairment recognition. So just to avoid that, the whole principle is if at the time of getting into the contract, there is uncertainty, they don't recognize revenue at all. So in a way, they've brought it as step one itself. And quite often, let me tell you, there can be a judgment may be needed to distinguish between what is a collectibility issue and what is a price concession. I did speak about single model, and like I said, under Ind AS 115, there are only two outcomes: either revenue at a point of time or over time. So we can maybe take some examples later, if you'll permit me. Then maybe I'll explain how this can differ. And a POC may not be the same as we applied in AS9. So even though we're talking about recognition of revenue over time, it may not necessarily be, the outcome may not be. Let's say if somebody says, I was in POC under AS9 and I'm doing recognition of revenue under over time under Ind AS 115, the outcome may still be different. Then the next bit is that there is very detailed guidance on performance obligations. So AS9 also, we did recognize if there was a contract with multiple performance obligations, we separated those, we recognized revenue and when each performance obligation was met. There wasn't enough guidance, or let me say any guidance actually, in terms of how do you recognize or identify these performance obligations and how do you allocate the revenue to these performance obligations. So there is very detailed guidance in Ind AS 115 in terms of performance obligation. Then again, if you look at the transaction price, there's this concept of transaction price in Ind AS 115. Transaction price, like I explained earlier, is a price which I expect to be entitled to. Now, Ind AS 115 brings in detailed guidance in terms of how to deal with variable consideration. It could include discounts. What about significant financing component? What about non-cash consideration? What about consideration payable to a customer? So many principles are discussed here and guidance is available on them, which was not there in AS9. And I would say not all of these may be clarificatory. Some may actually result in significant impact in terms of how revenue was recognized. And I'll just take half a minute more in terms of again, detailed guidance. If you see, there's very detailed guidance in terms of principal and agent, as to principal and agent. And among other things where there is detailed guidance is warranties and licenses, contract costs. Like I said, now there is a single model dealing with construction contract and sale of goods. So if you recollect in AS7, contract cost could be amortized, but in AS9 there was no such provision. So now when you want to come to a single model, and there are provisions in terms of how to deal with contract cost, it will also impact the accounting for sale of good transactions. So many more such differences, and of course extensive disclosures which have been introduced by the standard. So I know I've given a long list, but and I know some of them may seem very theoretical right now, but I'm happy to explain whichever one through an example, over the call.
Okay, thank you, Archana ji. It's a very kind and elaborate point you have mentioned about the basic principles governing AS and Ind AS. Now, moving forward, Mohan sir, when can we say the sale of goods has been affected? As per AS9 and as per Ind AS 115.
Okay, so I think Archana has already answered that question, but I will repeat the answer. As far as
actually, I want to make one example as well. If we take an example wherein the sale have been completed and even consideration received, but the customer has not taken the delivery of such goods and shall be taking the same after 3 months, what would be the accounting effect in this situation?
Okay, so let me answer that from both the angles, from both the points of view, Alokji.
Yeah.
Okay, first, the first question which you asked me was, when will the revenue be recognized? As Archana ji has rightly mentioned, the standard uses the word called as when control has been transferred to the customer. Now, this has to be read with the fact that the standard is titled as revenue from contracts with customers. So the contract itself, in many cases, will actually specify when the control is being transferred. It could, it could specify. It would depend upon the nature of the contract also. This is as far as I'm limiting myself only to the AS right now. I'll come to the AS part a little bit later. Now, to the question which you have asked, whether I think if I may repeat your question, you're saying that the sale invoice has been done, consideration has been received, but the goods have physically not been transferred. Am I right?
Yes, sir.
Goods have physically not been transferred because the customer has wanted the goods to be delivered after some time, you said, some 3 months or something, you said, right?
Yes.
Okay. So, this is a concept which is called as bill and hold sales in the Ind AS jargon. There's a specific paragraph. If I'm not wrong, it's B81 in the standard Ind AS 115. Now, here there are a few conditions to be met for recognition of revenue. Whether revenue has to be recognized or not, there are some conditions mentioned by the standard. First is whether it's a substantive contract. It means that has the customer requested that this particular good should be delivered, after a particular period of time or whatever it is. Whether there is a request from the customer, that means it has to be a substantive contract from the customer's point of view. The second is, can these or the goods in the contract be separately identified? Is there a separate identification which is possible in that particular contract? And your question said that the goods have already been manufactured or have been invoiced. I'm assuming that the goods are ready for transfer.
Yes.
The goods are ready for transfer. And if the goods are ready for transfer, and finally the supplier, the seller, should not be in a position to redirect the goods to any other person. That means allocated to that particular customer. If these 4 conditions are met, substantive contract, no power to redirect, and the fact that the separate identification is possible and it is ready for a transfer, these 4 conditions are met, the entity can recognize the revenue on the basis of this, what is called as, the concept is called as bill and hold sales here. If none of these or any of these have not been met, then it may be difficult for them to contract to, sort of recognize the revenue as per the standard. You may have to look at other portions of the standard like contract asset and all those things for this particular, in case he's got some consideration from the advance or that would again depend upon the specific, terms and conditions what have been mentioned in that particular contract. So this is only from the point of view of Ind AS. As far as AS is concerned, since this is a sale of a product you mentioned, again, the standard said transfer of significant risks and rewards. It's as simple as that. It's just says transfer of significant risk and reward. At what point in time has this risk and reward transferred in this particular contract? I can give you an example which happened in the same situation here. If there is any risk which the supplier is holding, like for example, it could be an inventory risk, it could be a warehousing risk, it could be any other risk which he is holding, right? if he is holding or if he's carrying some risk just because he's keeping the goods on behalf of the receiver, in that case, again, I think significant risk and reward transfer that concept may not have been met. So even in AS, I think he may not be able to recognize the revenue unless and until he's got some third-party insurance or the customer has requested him to do the insurance on his behalf. Basically, it would be inventory risk. Who is carrying the inventory risk? If the inventory risk has been transferred, I think then he can recognize revenue even under the AS one. Archana, please feel free to correct me in case of any of the things here.
Yeah, Archana, you can add anything.
Yeah, if I may, sorry, I know it's an interesting topic. So I'm totally in agreement, sir. I think my understanding is that largely as far as bill and hold is concerned, the principles have not changed between AS and Ind AS, so the same will apply. But I just want to, since you've raised this, I want to, and we also have auditors on the call, I want to just bring in a word of caution. I think we should, near the cutoff date, we should be very, very careful. I think this bill and hold is a very serious issue.
Yeah.
So there could be performance, pressures. A company may want to show, the management may have their bonuses linked to it. Or there could be various other business pressures because of loan covenants, etc. And you may want to show sale has happened. Now, one classic thing, I think some of the examples you took are very interesting, like warehousing and so on. I typically look at it like this: if I had made the sale, would I really keep anything with me? And if I'm incurring warehousing cost, I would recover it. Why would I incur any further cost once so-called the transfer of risk and rewards has happened? So be careful when in these contracts, you first of all see, has the company given any financial incentive? One may say, you may come out with a scheme to say, listen, if you take it now, I'll give you 2% discount. So somebody will buy it even they didn't need it because you were going to give a 2% discount. If there are financial incentives, I'm not saying it doesn't mean sale has happened. Just be careful. Financial incentives given just to get someone to pick it up. Now, let's say the customer picks it up just because you're giving a financial incentive, but he doesn't have warehousing capacity. So are you going to keep it? Are you going to incur the warehousing cost? Insurance, I think you took. I think these are very important ones. So just be very careful that if anything which you would normally not do, if that is being done in these situations, I would really question the bill and hold. And towards the year end, especially, yeah.
Towards the year end is a very good point, actually, because that's
reporting period, reporting.
You would have an incentive. Okay, Archana, just to add on to this, just think about, I don't know, because Alok said that the invoice has been raised. Would GST help in any matter in this, in any manner?
No, I think you can very much have situations where the point of recognition under law would be different than point of recognition
GST, right?
accounting. Yeah. And since we're on this topic, if it's okay with Alokji, I'll just maybe, since we're discussing control versus risk and rewards, maybe we can discuss
Yes.
the related issues. So I think this bit is very important. And the second bit, I think if we can just discuss quite often this issue of CIF and FOB comes up. So if I can just share my views on it, I think because I tend to see a very rule-based approach being applied. If CIF is this, I will recognize revenue then, or FOB. My only request is do not go by. These are all shipping terms. These are not necessarily indicative of transfer of risk or rewards or even control. So to take a very simple example, let's say I am the company and let's say Alokji is my customer. And he's saying, listen, Archana, I'm not able to arrange for shipping. Can you just help me get the shipping done also? So I'm going to help him because he is my customer, good customer, have long-standing relationship. And I'm also going to obviously bill him for the shipping, right? So the shipping may be done in my name. The insurance I may take out in my name. But ultimately, am I acting as a principal or an agent? If I'm only doing it on his behalf, okay, and I'm going to fully recover, let's say there is no markup, I'm not providing any shipping service, whatever is the cost, he will reimburse me. If there is any, let's say, damage to the goods during transit, he is the beneficiary. I may be the policy, I may have taken the policy, but he is the beneficiary. Then I would say I have risk and rewards during transit. So always, quite often shipping terms are commercial terms, and you actually need to see how do they translate in terms of risk and rewards or transfer of control. And I've seen this as a very generic issue across 2 decades. Still, I see this issue coming up. And there's a very good ESC, very, very old ESC opinion, which kind of highlights on this principle. So I thought since we were discussing CIF control.
I think this CIF and FOB came more from the AS point of view, and we're trying to apply the same for Ind AS also, I think.
Yes,
right?
Yes. And you're right. In Ind AS, I think there is once we maybe go further in terms of performance obligation, etc., and control transfer. This question came up quite even significantly when the standard initially came out. Is shipping a separate performance obligation? So let's say it is not a reimbursement. Let's say I'm actually even making a markup on the shipping, but is sale of goods and shipping two separate performance obligation or one? So maybe we'll come to that later. But right now I wanted to discuss control versus control and transfer of risk inwards. And this bit is common in both. I think I just wanted to emphasize, don't go by risk shipping terms. Look at, I think what you very clearly highlighted is inventory. Who's got the inventory risk, etc. Look at that very carefully.
Yeah, because Alok, I'll just add on to what, if you don't mind, I'll give an example. This happened actually. Yeah. We'll keep the names. We'll keep the names silent for a moment. When the lockdown was announced on 25th of March, right? There was a customer who was, a customer had to lift a particular material. It was the customer's responsibility to lift the material from Bangalore. Okay. And the lockdown was, announced. So he could not. It had to be transferred to Delhi, right? He could not. Obviously, he could not because of the lockdown and all those things. And he told this particular person, that the supplier, that okay, you can keep the goods with you, but once the lockdown is lifted, we'll come and take the goods, or we'll transport the goods. Now, this company kept it in their warehouse, but took insurance in their name, in their individual name, right? They took it in their own, so sort of bearing the inventory risk, so to speak, right? Because they did not know what is to be done. They just kept it there, and they sort of took the inventory in their particular name. So this raised a question whether they could really recognize revenue, even though all their obligations were complete. The machine was done, inspection was done, only transportation, which was the customer's responsibility, only that was not done. But because they did this, they probably had to hold back on the revenue, because they could not actually say that, control has been transferred, and they're still bearing a part of the risk here.
It's very interesting, but I'm just thinking out loud. Could one have argued that if I could have demonstrated transfer of risk inwards, could I have argued that to the extent I'm bearing the warehousing, it's a discount? I don't know. But
it's correct.
Yeah. So I don't know. You're right. It's a very facts and circumstances, this thing, and revenue is very very difficult to give a single answer. So,
no, but here this was a PSU, so CNH auditors and all those people. So we sort of
No, I'm with you. I'm just saying it just triggered a thought process.
Yeah.
I think you're right. I think in terms of warehousing and insurance, etc., is very careful. Yeah.
Good, Alokji.
Yeah. Thank you, Archanaji and Mohanji. You touch upon the two important things. That is, the first is the cutoff date, and second is the shipping charges been reimbursed by the supplier. Now, my next question to Archanaji, whether the reimbursement of the expenses and charges are recovered by the customer in the invoice itself, whether such recovery of expenses should be termed as revenue or should it be reduced from the cost?
You're referring to charges for shipping, etc.?
Yes.
So I think we can just continue the discussion. And
yes, please.
I think if I look at, let me put it like this: I am selling goods, I'm also shipping it, and let's say with the markup. So my cost of goods produced is 100, my shipping cost is 120, and overall I'm selling it at 150. Okay, so there is a markup on 100 as well as 20 both. Now the question is, what time do I transfer control? If I say control is transferred after shipping is done, okay, then actually all of it is a single performance obligation. I would not look at it as a reimbursement. It's not really a reimbursement. I'm saying my sale happens when goods reach the destination, right? And that requires me not just the cost to produce, but also the shipping cost to be incurred. And like I said, on 120, I've applied the markup. I see there to be a single performance obligation. One may argue there are no two performance obligations, right? Now, in AS9, I think if I recollect, I think one could have argued, are there two, and if shipping is in progress, let me recognize at least sale of goods and shipping is a separate one. I don't think so. I think if you ask, I'm just saying these are issues which used to come up. But here, if you ask me, it's a single performance obligation the way I see, and you will recognize revenue for the entire amount once the goods reach the destination. If this is how it is, yeah.
Okay. Yeah. Thank you.
But let's say if it's the other way around, and maybe first we can discuss this, and then we can come to the other one wherein control transfers at the point of dispatch. But maybe that's a separate one. So do you want to add anything on this?
No, it's fine.
Yeah. So
Okay.
I'm just saying, typically you would look at it, reimbursement. If it's a reimbursement, pure reimbursement, actually that means a reimbursement means it's not my cost. Okay. I'm incurring it on behalf of someone. I would actually say neither the cost nor the reimbursement should hit your P&L, because that is neither your expense, neither your revenue. It would come into income only if there is some margin that is being earned. And then in that case, it's really a service being provided. Are you getting the point? So if I'm saying,
Yes.
it's like saying, you're saying, Archana, I don't have, you're going there, can you just make the deposit on my behalf? I'll pay you later. So it's not my expense. So reimbursement in a traditional way would mean that. But if you say that, and therefore I would exclude, but if it is a service I'm providing, then I would look at it.
Okay. You mean to say if there is markup, it is very clear you have to consider it as a revenue.
I'm saying, yeah, if it is a service I'm providing, okay, then of course it will get into my revenue recognition. But if it is not a service, if I have just the cost to cost reimbursement where it is very clear I was only acting as an agent, I was not even incurring it on my behalf, it was just done to facilitate it for you, and it's immediately got reimbursed, I would probably not take it as a revenue. Yeah.
Okay. Thank you. You touch
So
upon
then you kind of knock it off from the expense itself.
It will come off from the expense completely. It will be there, nothing
it comes off from the expense. Yeah.
Yes. You touch upon one more important thing is that the cutoff date. Many of times what happens is that revenue is recognized, the sale of goods has been effected, and a buyer has right to return those goods within a specified duration of time. Mohanji, please enlighten us with what to do in this situation.
Okay, so I think we should bring in this concept of contract liability, Alokji. We should discuss about this contract, because there are two new words which have been introduced, new terms, shall I say, introduced in AS. Again, not there in AS. The AS did not have this word called as contract asset and contract liability. So basically, the contract asset is when I've got a right to consideration, and the contract liability is when I have got an obligation to pay or transfer goods or services in case I've received the consideration in advance. Again, under the guidance, under the theme that, okay, control has been transferred, you are basically talking about a situation wherein a customer has got a right to return he's got a right to return certain goods here. Now, what would typically happen? What would typically happen is that the entity will have to estimate. The entity will have to make an estimate of what could be the possible returns. This could be based on, their past track record or whatever. They've got some data about it and whatever it is, right? So the entry for, the amount which they expect the customer to return would be shown as a contract liability. So we can take a hypothetical number. Suppose there are 100 units going to be sold at, let us say, 30 rupees each. And, the entity is expecting, say, 10% to be returned. Right? So the 10%, they will make they'll create a contract liability for them. The trade receivable will be for the entire amount. Sales will be for 9,000 for the 90 goods or 90 numbers. And for the 10 numbers, it will be a contract liability. Okay, but unfortunately, or rather fortunately, the journal entry doesn't stop there. I also have the right to receive that money back, the goods back from that particular customer, right? So to the extent of my cost or my inventory cost, I will also show a recovery asset for that, a contract asset for that particular item there. To the extent, so that margin basically will be contract liability minus a contract asset there. That will be your margin here. So because the customer has got a right to return the goods. Now you may ask me a question, on what basis will I estimate this right to return? Should I make it on the basis of past record? Or suppose it's a completely new line of business, what do I do? Okay, suppose they have no data, for example, or
yes,
as per you will have to make an estimate, because you will probably have some data points. Some estimate will have to be made. But since your question is the customer has got a right to return, I'm assuming that he is, also how much is expected to be returned. You can take, for example, a typical e-commerce company. They would have to know, right? They'll have to make an estimate of how much they could possibly be returned, and you'll have various such schemes here. But to answer your question, the answer is going to be contract liability for the amount which is expected to be returned, and contract asset for the cost of those goods, which will ultimately go and hit your inventory when they are returned. This will be the journal entry which will be made there. And of course, the contract liability will be the sale price, because that's what you have to return to the customer in case the goods are returned. This is what I will do.
Okay. So what if about AS9?
AS9 is silent on this. So, we don't have any specific guidance, I think, in AS9 of this, but we will have to look at again what has happened in this particular circumstance. Because see, again, in this particular case, I'll have to again look at the concept of significant, risk and reward which has been transferred there. So I recognize probably revenue for this, the entire, whatever the amount is which has been sold. And when it is returned back, I'll have to probably make a separate entry for that in AS9. Because this detailed guidance which is there in 115 is not there in AS9.
Archanaji, you may add something if you want to in respect of the.
So if I understood correctly, I think in Ind AS 115, we are saying I will have a refund liability, which I'm totally in agreement. And I think if I just highlight the positive bit of Ind AS 115, I think that's what Sir is also trying to highlight, that in AS9, if you had variable considerations, there was lack of clarity and there was diversity in terms of how to account for it. One may say, listen, there is uncertain measurement and therefore I will not recognize anything at all. Some were doing that I will do the best estimate and recognize revenue recognition. So I've actually fallen into the second bit. But I think Ind AS 115 makes it very clear that, as far as if you've got a situation where there is a right of return, then you measure a refund liability at the amount which you do not expect to be entitled to. So I'm just going back to what I had said earlier for transaction price. It's what you expect to be entitled to. So therefore, refund liability is what you don't expect to be entitled to. I think that clarifies. So it's taken away that diversity. I think, sir, that's what you're referring to in AS9, that there was diversity, right?
Yeah.
So I think a company could have very easily said, this is my best estimate. And there were, if I recollect, there was very good ESC opinion, if I recollect, which dealt with customer returns and so on. Wherein, especially in the retail sector, because this was very common. I think they permitted you to recognize and make a good estimate or provision for sales return. But it's something similar, I would say. Yeah.
Okay, thank you. Now I'm move on to next question, that is for Archanaji. It is the revenue recognition, the material rights to the customer. Could you please explain what is the material rights to the customer with an example?
So I guess what you're alluding to is something like a customer loyalty, right?
Yes.
So effectively, it's if I was to put it in a very simple way, it is like saying that I have undertaken a transaction and as a customer, but the amount I'm paying is not just for this transaction. It also gives me, in addition to this, some other right. So let's say if I have booked a ticket with an airline, let's say I paid 10,000 for the ticket. So why do I get the benefit of this? The current flight, let's say from Delhi to Mumbai, I also get a mile point, and that mile point then further gives me a right to some free goods, etc., or some kind of a discount for a future transaction. So effectively, this transaction is giving me a material right, which is in addition to my this thing. So I think there the standard now very explicitly recognizes that effectively the consideration or the amount that the customer is paying you for is for two items, right? One is for the flight taken currently, and one is for the benefit that the customer will be able to get in the future. And that is what they're referring to, a material right. And they're saying this therefore needs to be measured. Now, earlier, I think if I go back to AS9, there was lack of guidance. There was diversity in practice. Even before, let's say, global guidance came out, many said, let me recognize full revenue. So let's say if I'm the airline company, I would recognize full revenue of 10,000, but I will make a provision for the benefit I need to give to the customer in the future. So let's say the mile points he's earned, let's say he's entitled to some free goods. So I will make, an estimate of what is my cost to fulfill that promise, and I will make a provision. So you have gross recognition, full revenue, and a provision. Now, what we are saying in Ind AS 115 is that effectively there are two performance obligations. The airline company has to fulfill two bits. Performance obligation is what all I am promising that I will do. So here the airline is actually making two promises. One is to take you from Delhi to Mumbai, and the second is to give you that free gift. So therefore, the revenue will be allocated to the two items. To the extent revenue is allocated to this flight, let's say Delhi to Mumbai, you will recognize. And for the other bit, you will defer revenue. So now if you look at it from a P&L perspective, ignoring materiality, what will happen is you have, presuming the difference is not material, you will do a net recognition. So rather than have full revenue and a provision, you will actually do a net presentation. And of course, you've got 10,000. So let's say my revenue to be recognized is 8,000. 2,000 is the cash I've received for that. 10,000 is the cash I've received. 8,000 is my revenue. So 2,000 will become a provision or a liability in my financial statements. So I think it clarifies that. I think even in AS9 over a period, as in when guidance on customer loyalty came under in IAS 18, in a way it started getting applied even in the Indian context. So we did see in India diversity. You had many companies which had moved even for customer loyalty and accounting under AS9, where they moved to this kind of a mechanism of allocating revenue to the two items. Though, of course, the preferred one remained the gross one because that gives you a higher top line. So I think from that perspective, this very explicit guidance in India's 115 becomes very relevant.
I think one of the few areas where matching concept is working also, Archanaji.
Yeah.
This is one of the few areas where the matching concept also seems to be coming to play.
Yeah, absolutely. You're right. Because in a way, absolutely.
It sort of matches the cost with the revenue because it takes some thing off, right? Yeah.
So I think this is very important, and this will be given the fact that customer loyalties these days are so common. Earlier, it started with credit cards and then maybe airlines, but now just about so many outlets and so many brands have their customer loyalty.
Even if you take, for example, all these, all your Uber and all these things, it becomes really a massive calculation exercise, because they say some, next ride is 50% free and all that stuff, right?
Yeah.
So a lot of estimates will have to be done for this. It's a pretty complicated, complex. But you're right. I mean, this is what will have to be done for this.
Absolutely.
And it's very important, considering the new age companies coming up. Everybody gives a customer loyalty program.
And you're right. There are many complications. So let's say today I estimate, while I've done how do you really do this allocation? Like you just said, is an important issue. So let's say I've got 100. I'm just taking a simple example. 100 customers who are entitled to some customer loyalty points. Should I? How much amount do I allocate? Should I assume breakage, which is a new concept which comes in? So I've got 100. What are those customer loyalty points which I believe will lapse without getting utilized? So I will, if let's say total out of these 100 customers have accumulated, let's say 1,000 points. I know only 800 will be used. So do I do valuation of 8 or do I do valuation of 100? The answer is probably 800. Now let's say my estimate changes later. I expect the number to be utilized to be more or less. Then how do you? So yes, it comes with all its complexities. But yes, definitely under the new standard, it will be considered, material right will be considered as a separate performance obligation. And therefore, it has a direct impact on your top line.
Okay, thank you. Now my next question to Mohanji. It's very specific question for the job work transactions. When we talk about the manufacturing entities, it is very common to see that raw material is usually procured by entities and given to job work for job work activities. Here, generally, the transfer of material is booked as sale of RM and material is received back is booked as purchases. In substance, it is a job work transaction. How should this transaction be recognized under AS and IDS?
Archana, you want to do an initial thought on that? Then I'll later add on. So you're on mute, I think.
You're on mute. Please unmute, Archana ji.
She's not.
Archana ji, please unmute your.
Oh, sorry. I said I'll be happy to because I've always found this to be an interesting issue, especially at the time.
The reason why I told you was the moment I allowed to ask a question, I could see a smile on your face. So I sort of I will produce this.
And I will give an answer which probably it's not very commonly done, but I feel it's.
I know. Yeah. Please
I'll give that. So. See, this is the issue with AS9. AS9, at the way the sale was, there was diversity in interpretation because the way AS9 was drafted. So if you had a conflict of, let's say, legal sale versus transfer of risk and rewards, okay, what do you give primacy to? So obviously, if risk and rewards have transferred before legal sale, very clear you will recognize. Or what if legal sale, the other way around. Sorry, if both transfer at the same point, great. Okay, now the question is, if the legal sale and the transfer of risk and rewards do not take place at the same time, what do you give primacy to? That is where the issue comes. Now, in this case, the way the standard is drafted, over the years, at least I've seen ESU opinions in the practice, it's been split. There are many who say you will still give primacy to risk and rewards and recognize revenue only when risk and rewards transfer. Then there is another group which reads the standard in a different way. Now, over the period, therefore, what happened was a practice developed in AS9 that if somebody was to recognize revenue only when legal sale happened, it was becoming difficult to really qualify because the standard wasn't very clear. So in this case, effectively, like you just said, substance is its job work. Okay, yeah. I'm giving it and it's coming back, and therefore the transaction should only be for the job worker expenses. But because of certain, I think if I'm correct, for indirect tax reasons, etc., and invoices usually cut and so on. Typically, if I can demonstrate there is no transfer of risk and rewards, okay, I would not be in favor of recognizing gross sale and then gross purchase. Okay, so I'll take an example for the benefit of everyone. Let's say my cost was 100. I transferred it to the job worker, let's say at 100 itself. Mm-hmm. The job worker does work on it and then gives it back to 120. So the question is, should I first recognize a revenue of 100 and then recognize a purchase of 120? Okay. So my answer would be no. Now the question is that how do you then really deal with the view for that group of people who would like to take the view that AS9 revenue has to be recognized on legal sale? How do you deal with those situations? I would say that in your P&L, I would actually knock off this transaction. So let's say when I sold to the job worker for 100, my cost was 80. Okay. I would recognize cost of production at 80 plus what I paid to the job worker, which is 20. Okay. And I would recognize my final revenue only from the customer. All this thing which has gone back and forth, I'm okay to present that in the notes to the accounts. That's one way. The other is that you do that in the inner column of the P&L. So, you can do the inner column will reflect therefore the legal sale, and the outer column can reflect the substance sale. Like I said, not many actually agree with this approach, but I feel that's one way to balance between legal and substance, because legally one could argue that sale has happened and you need to recognize revenue. And there is split view of how AS9 was interpreted. Many, like I said, felt that AS9 goes by legal sale. But if you were to take the other view that you should show only sale where in substance risk and rewards transferred, I think one via media is, like I suggested, you could do that.
Ind AS, Archana?
Ind AS, I think Ind AS is very clear because I don't think this legal sale issue is there. So I would very clearly not go by legal sale. Like I said, even if you were to speak with many, even regarding the ESC opinions, the intention seems to be to give primacy to risk and rewards. The way it is drafted is not very clear. And under AS9, it is just the drafting. I don't think the intention was necessarily that. But the way the drafting is, you're left with two options. But in Ind AS, I think it's very clear you would only do when transfer of, I would not do this back and forth. Yeah. But if I just add, there are instances wherein, even so-called this material has gone to a job worker and come back, I can demonstrate that there is transfer of risk and rewards. So let's say the material is similar, he can intermingle, he can substitute material, etc., then it's a different issue. But if you can clearly demonstrate that the material I've sent to the job worker, it is demarcated, that is the only material the job worker can use, it cannot be mixed with the material he would have got from other customers, etc. I mean, I'm just saying if you can demonstrate that, then yeah.
Yeah, fair enough. I think that's pretty much what I would have also said, Archana ji. And Alok, just to I'll add on to your question. I'll just add on to your question. And same job work example. Mm-hmm. I send it to a job worker. He does some job work and ultimately transfer it to my customer directly. It doesn't come back to me. This back and forth does not happen. Right? So this is also a possibility there. In many job work transactions, this also happens. I send it to him and it never comes back. So this entry for purchase, which you mentioned, will never happen to me at all, because it's not going to come back to my, the physical movement of the goods does not come back to my,
Who will issue the final invoice to the customer?
Yes.
I will issue the final invoice to the customer.
So you will issue.
And then
I'll only get a job work invoice from him, job work charges invoice from him. That's all.
So to the final customer, would I issue any invoice? No.
I would issue an invoice. Yeah.
You
As a
would.
supplier, I would issue an invoice. Yeah. Okay. So here, I think again, Alok, what will happen is that this again from the India's point of view, again this control issue comes into picture here, right? When does it actually transfer here to that particular customer? Now it has gone to the job worker. Okay. So that guy transfers it after, let us say, 1 week or 10 days, he transfers it physically moves to the customer's premises. So it's important to recognize at what moment of time this control transfers, whether I send it to the job worker or whether when the job worker sends it on to my ultimate customer. Okay. So the response to that would be, again, this depends upon, but invariably, I think if it's the job worker, which we have identified, I would probably say that the risk and responsibility still remains with me till it is ultimately gone to the customer's premises. Delivery could be an option there. When it's actually delivered, you can say that the risk and responsibility has been, the control has been transferred at that point of time. So this is just a variant to your question on the job work part. Because see, as Archana had also told earlier also, India basically talks about the substance over form situation, right? It's written all over India, substance over form, substance over form. What is substance over form? The previous example you gave was a clear example of, you said it's only pure job. That's why Archana ji gave this explanation of how she treat that transaction, wherein this back and forth happens. So in substance, I will do that sort of accounting only. AS, again, lack of clarity, and what Archana has told us is basically from practical examples only. But yes, I would tend to believe that in the AS, they always feel this legal title is very, very important. They've gone by that only.
Okay, so let me summarize that key. If a customer insists, if a client insists to book the transfer of raw material as in revenue, and later on the purchase from the job worker is to be grossed up, whether it is as an auditor, we should allow to do that?
Auditor, you should allow to do that is.
If I can, I know it's a controversial one, but I'm happy to say I never permitted it. We were able to convince them to do that inner column. I think as long as you do the inner column thing, they're still okay. Because somewhere they're able to bring it on to their P&L. But we believe that the final substance position is...
Even a disclosure will not help you. Even a disclosure will not help you. You can't disclose this. You'll have to do it this thing only. You can't disclose this as a separate disclosure in the notes and accounts.
Okay. Thank you. Now my next question is with respect to the revenue recognition for technology-based company that operate as a marketplace for online food delivery. This question is to Mohan sir. This is revenue arising for the commission paid by restaurant partners on successful orders, service charges and delivery fees. This is a typical example with respect to the food delivery transactions like Zomato.
Okay.
So how to recognize revenue in this?
Can you repeat the question, please? Sorry.
So it's revenue arising from the commission paid by restaurant partners on successful orders, service charges, and delivery fees.
Commission paid by the restaurant owners to this technology company also.
Yes.
So it's an income for the technology company. So we are talking from the point of view of the technology company.
Yes.
Okay. On the basis of number of orders placed.
Yes.
Yeah. Okay. So this will again go back to this concept of variable consideration that would come into play here. And the standard, 115 talks about two situations here. They're talking about expected value or most likely amount. These are the two possibilities which have been given by 115. So again, here an estimate will have to be made. Expected value means you'll have to make a probability weighted estimate of how many orders these people could probably get and how much of commission they could possibly get here. And most likely amount, they should put in various scenarios. They should put in various scenarios based on different, maybe it could be on basis of class of customers, they could be on geographical location of customers. They would put a most likely amount. Either one of these two methods is permitted in India's 115. They would have to make an estimate of what is going to be this expected value or most likely amount and then calculate revenue accordingly. Again, If you talk to me about AS, Alok, I don't have much clarity on that in AS because AS is pretty much silent on this particular aspect here. But again, as we've been discussing, I think we'll have to look at what specifically that, again, AS talks about income from rendering of services, whether it's going to be done over a period of time. I mean, I should say probably POC method. As and when they're doing this order, should they recognize revenue or not is something which will come up in AS9. The amounts could be different. The amount of revenue recognized under both AS9 and 115 could be slightly different.
Okay. In addition to that, there is one more transaction for the technology-based company, a similar company, one-off connection fees paid by the restaurant partners to cover cost of hardware installed in the restaurant and the sales and onboarding process.
This is only one type of transaction, only one time, right?
Yes. One-time upfront installation fees taken from the restaurant partners.
So they will recognize the revenue when they're entitled to that particular amount. When they're entitled to get that amount, once their obligation has been complete, they have a right to receive the payment. They can recognize the revenue from this. Because here there's no estimate, but it's a one-time fee basically.
Okay. Thank you. Moving on to Archana ji. Now my next question is with respect
to... Sorry. Since you've taken us to the restaurant questions,
please,
one more topic for discussion. I'm going beyond that question.
No, please.
But this is one bit I think I was keen to actually discuss, and e-commerce I've been referring to in bits even in my earlier comments. Now, if I was to, you just took the example, let me just take any of the online, I don't want to take any name actually, but you look at all the online apps which kind of tell you, you've got so many Swiggy, Zomato and the likes,
yes.
Where you order food and, they have a tie-up with the restaurants and they give it to you. Or even actually, you can even take an airline, a portal wherein you go book tickets, right? Or even book a hotel. I think a very interesting question here comes up. If I was to take a simple transaction, let's say I'm a customer, I book a meal or I book a ticket or whatever, right? This company which is managing this portal gets a fee commission from the restaurant or the airline company, etc. Okay. Now it may also take a convenience fee from the end user. It may not. So the first question which becomes important here, and that's why I said in my initial comment, I said revenue from contracts with customers, and at times there can be a question as to who's your customer. So in this case, one of the questions which comes up is who is the customer? Is the customer the airline which is paying commission to this portal, this so-called entity, or is it the restaurant which is paying the commission, etc., or is it the end user? Okay, and I'll tell you why this identification of customer becomes important. So let's say that quite often you would have seen, and we all enjoy the benefit, these sites offer you discounts, cashbacks. So let's say they say that if you were to book a meal or book a ticket, you'll get a 50 rupee cashback. Okay. The commission they're getting from the company, I'm taking an easier situation right now, from the airline or the restaurant, the commission they get is 100, they give me a cashback of 50. So the question is, should they recognize an income of 100, an expense of 50, which is a cashback they've given to me, or should they recognize an income of 50 itself? Now, if I was to say that both are my customers in a way, right, somewhere I will say my net revenue is 50. But if I was to say my customer is only the restaurant or the airline, then I would recognize a revenue of 100. And this I would take as some kind of a marketing expense or whatever and recognize that as an expense. So as you can see, it has significant implications for the top line. And there are more peculiar situations actually, because at times to get more customers registered on your website or on your app, you offer discount which is even more than the commission. So it could happen that I'm getting a commission of 100, I'm offering a cashback of 150. So does it mean I have a negative revenue? And of course, negative revenue, I think we've all accepted India's 115 recognizes that you can have negative revenue. Okay. So in this case, do I recognize a negative revenue and all those things? So there are those additional issues which are coming up as far as e-commerce is concerned. Who is your customer, like I said, becomes very important in that context. And therefore, one is to say that if both are my customer, the outcome is different and so on. So I just wanted to highlight this. There is an EAC opinion I slightly have I have somewhat a different way of looking at it, but very interesting perspective that the ESC brings out. And I mean, I would just suggest if people have similar transactions, they should kind of refer to that ESC opinion. There is, of course, in India 115, we still have very good guidance through the standard, etc. But in AS9, it was all the more less. And therefore, when to see this as sales promotion, or when to see this as reduction of revenue, I think there's quite a bit of a it's a much more complex issue for certain sectors, which may require very careful deliberation. And I can tell you, sorry, I know I'm digressing, but just one more example quickly, just to give I just want to kind of say that while broader principles to quite an extent may be similar, but the clarifications or some of the nuances that 115 is bringing is so important. So if you look at the impact of India's 115, some of the consumer good companies were significantly impacted because of the way they had to account for the discounts. Now, in the past, in AS9, they took many discounts to be, they classified them as sales and promotion, right? And they were recognized as expense. They were not reduced from revenue. Now, when you come to India's 115, I'm just jumping in terms of maybe this was a question in your subsequent this thing, but in India's 115, anything, the starting presumption of anything, if you give anything to the customer, any consideration payable to the customer, the starting point is that this is a reduction of revenue. I'm not saying it cannot be an expense, it can be, but I'm just saying that is the presumption. You give anything to the customer, it's a reduction of revenue, unless and until you can demonstrate that you've purchased some goods and services from the customer, and that is why you're paying it. So let's say I'm selling good X to the customer and I'm purchasing service Y from the customer, then of course I will pay for that. But let's say if I'm getting no goods and services from the customer, then anything I give to the customer, I think it makes it very clear it's a reduction. So I think, so when you look at the consumer markets, consumer goods industry, for example, like I said, many of the expenses which they initially took as sales and marketing, it took as expense, not reduction from revenue. When India's 115 came, it was all reduced from revenue. So same here, I think, in terms of identifying who my customer is this a consideration payable to the customer? Is it a sales and marketing expense? In e-commerce or in new startups, we've seen this trend of what they call cash burning, wherein initially just to attract customers, you know that you'll be giving discounts which are beyond even the revenue that you may earn, etc. So how do you deal with cash burning issues? Do you have negative revenue? Do you treat them differently from the normal discounts? So just wanted to highlight that there are some complexities as far as discounts or consideration payable to a customer is concerned. But my starting point for a consideration payable to customer will be a reduction of revenue. And in this case, I think the ESC discussion therefore becomes very relevant as to who your customer is and how do you then deal with it.
Thank you for the elaborate explanation about the e-commerce transactions, because one of the participants has also asked the question about the e-commerce transactions. Now, my next question to Mohan sir, it's with respect to the contract modifications. It generally happens during the live contract. The contract has been modified, and what would be the effect of the contract modifications on the revenue? If you give with the examples, it would be better for us.
Okay, no. So you're basically saying during a live contract, the contract has been modified, is what you're saying?
Yes.
Okay. And you only wanted to know about the impact of this on the revenue recognition part.
Yes.
Okay, so I think the first thing, Alok, is that whenever a contract modification happens, I think what we essentially have to see is whether it is a new contract or whether it's an amendment of the existing contract. Whether it's only a new contract or it's a modification of an existing contract. I think because if you say it's a new contract, you'll still have to follow all these 5 steps which you spoke about for the new contract. If it's a modification of an existing contract, you will just have to do a true up of the actual consideration or whatever consideration you're going to get over the remaining period of the contract. You will have to get. You will have to just sort of. Those figures will have to be accordingly recognized as revenue. So, since you asked me for a specific example, I'm taking an example, right? let us say that we have got a contract for selling of, let us say, 1,000 items of goods, right? 1,000 items of goods. And let us say a contract price of 100 rupees. This is what has been initially agreed upon. 1,000 items, 1,000 numbers of goods at an initial contract price of, 100 rupees. And let us say that this is over a period of 3 years. For the purpose of this discussion, let us say it's over a period of 3 years. End of the second year, let us say that the customer comes back to me and says that I want another 500 items. I want another 500 items, and at a contract price of, let us say, 90 rupees. And the term has also been extended by 1 more year. Let's say that the term has also been extended by 1 more year. So now we ultimately have 1,500 numbers which have to be sold. Initial 1,000 at a price of 100 rupees, and the next 500 at the price of 95 rupees. So for that next, what you can say, when the contract was modified, that 500 numbers, that is when I will have to test whether it's a separate contract, or whether new performance obligations have been have been identified, or it is only a extension of the existing contract. Say, for example, if the goods are similar, say, for example, just the items are the same, it's only asked me for more items of the same number. So it's just sort of an extension of that existing contract only. In that case, I need not take it as a modification of the contract. But suppose some performance obligations, additional performance obligations have been identified. Let us say, for the purpose of a theoretical discussion, that original contract did not have a warranty obligation, whereas the subsequent contract brought in a warranty obligation, brought in some sort of a maintenance obligation also, only for those additional items of 500 goods or 500 items that have been sold subsequently. So in that particular case, we should probably segregate these contracts and not merge these particular 2 contracts together. So the core of this entire modification, or whether we continue, whether we show it as a new contract, or whether we continue the old contract, would depend substantially on what the terms of those new contracts basically are. Typically, it could, for example, be only a pricing adjustment. In the example I gave you, it was only a pricing adjustment. There were no new performance obligations identified. There was no new other terms and conditions of the contract which are there. So in that case, I'll just take it as a continuation of the existing contract. But if new performance obligations have been identified, new terms and conditions have been put in that case, I'll have to take it as a separate contract. When I say separate contract, 5 steps which have been mentioned by Archana ji will have to be done separately for that. So this is how I would handle this particular transaction. Again, my answer, Alok, is from the Ind AS point of view. From an AS point of view, if you want me to look at this particular, I will have to apply it at that particular stage. So it's an event-based transaction here. Again, because AS did not speak so much about these things, I will have to look at it at that particular stage. What has happened in that particular stage? So say, for example, the contract was modified. Again, I will have to bring in AS9, significant transfer of significant risk and rewards. What has happened there? There, of course, we can use the same principles probably for segregation or bundling or unbundling of contracts. The principles can be the same between AS9 and Ind AS 115, though the guidance given in 115 is slightly more detailed than what has been given in AS9. Again, as we've been speaking throughout this webinar, more clarity in Ind AS 115. AS9 will have to look at it on that event-based sort of a transaction.
Okay. Thank you. Now my next question to Archana ji, it's with respect to the allocating the transaction price to performance obligations. Let me take you to an example. Now, if a manufacturing entity is providing a composite contract involving supply of machinery with installation, 2 years free service and 3 years warranty on spares, how to determine the performance obligations in this?
So I think maybe we'll just go back to the basics to see what is a performance obligation. So like I said earlier, in very simple terms, it's the promise of what all I will do. So how many promises have I made? Now, to identify those promises, and obviously as and when you fulfill those promises, you recognize your revenue. Now, the standard says that for something to be a performance obligation, there are 2 conditions in a way. One, and I'm just explaining it generally. One, it has to be distinct on its own. And the second is that it has to be distinct in the context of the contract. So just to explain, when I say distinct on its own, means it should be able to provide some value goods or services and have some relevance on its own. And when I say in the context of the contract, it should have some value in the context of the contract. So let me take a very simple example. Let's say I want someone to construct a house for me. Okay. It would require the person gets the raw material, cement, brick, wood, whatever. Then it would mean the contractor would integrate all of this and, do which is the integration services, the construction services, and then the output is the house. Now, if you look at it, brick, cement, all of them have value on their own. They can, they can provide some this thing. They can be used by a consumer. So they are distinct on their own. But are they distinct in the context of the contract is what needs to be seen. Now, if I had hired the contractor saying, listen, I want the house, I didn't hire him just to get me cement or brick or wood or something like that. But the promise was the contractor will construct that house. So therefore, while these brick cements they may be distinct on their own, they are not distinct in the context of the contract, right? And I think that's the same lens that we will need to kind of apply when I look at your when I look at your question. So I think you said it is a machinery with machinery with. Can you just repeat installation and
with free installation, 2 years service, 2 years free services, and 2 years warranty of the spares as well.
Yeah. So like I said, I would apply the same principle of distinct in the context of the contract and distinct on its own for even for this. So let's say installation. Let me first take installation. Now, if installation is so routine that anybody can do it, okay, I could have still bought the machinery from this party without necessarily taking installation from them. I choose to take installation, but it's not that you take out installation and I would not have entered into the contract. In that case, I would say machine and installation are two different performance obligations because in the context of the contract also, installation is distinct. But let's say installation is complex. Okay. Let me take, for example, let's say I'm getting an air conditioning ducting done, and that requires, let's say I want a cold storage, and it is very important that the raw material is stored at a specific temperature, otherwise it will rot or so on. And therefore, each corner of that room or each square feet of that room has to have the same temperature, etc. It is not just about it. The installation also requires significant designing or some knowledge, etc. In that case, installation is so specific, I would not have taken, you could not have distinguished it from the item itself. So if the installation is complex, no one else, I'm just saying simply, right? It's complex, no other party can provide it, and all those things. It results in a integration in a way which becomes essential to the installation, to the overall item being relevant in the context of the contract. I would say it is not a performance obligation. So I think installation, depending upon facts and circumstances, may or may not be a separate performance obligation. Now, I think then you said free services and warranty. I think that I'm not very clear about, because warranty is also nothing but maintenance. It's extended maintenance, right? And free service would also be somewhere relating to, I'm presuming, maintenance. So if just like we discussed installation, if I was to discuss maintenance or warranty, etc., I think if you look at that, I think India's 115 brings in clarity. Okay. Though according to me, the accounting should have been same, but there was diversity in AS9 all said and done. Now, when you look at servicing or warranty, etc., let's say there is what I would call normal warranty. I'm just using the term in a layman way. Your normal warranty without which the good is never sold. Let's say you go to buy a mobile, it comes with a 1-year warranty. Even if you don't want to take the warranty, can you say to the shopkeeper, please don't give me the warranty and reduce the price? It comes with it. You can't touch it. Right. So to the extent it is not separable in that sense, it becomes an item which is not distinct in the context of the contract. I would treat it as one. And therefore, then you have what is called an extended maintenance, or you can even call the word warranty for it. Okay. So let's say typically the goods come with a 1-year warranty, but for whatever reason you've entered into a 3-year or a 5-year contract. Okay. That is extended, which is optional. You may not take. I would say that is a separate performance obligation because, like I said, because it's optional, it is distinct in the context of the contract. I need not have entered into it. I've chosen, but it is a separate performance obligation. So when you look at this warranty bit, what is normal warranty and extended warranty? Unfortunately, this distinction was not very clear under AS9. So you did have companies which would recognize even for extended warranty revenue. Okay. So basically, let's say the contract says supply of goods 100, warranty, which includes extended warranty 30. They will recognize revenue as 130 and make a provision for warranty, including extended warranty. Whereas actually what should have been done is the recognition should have been done only for the normal warranty, not extended warranty. Okay. So your revenue only should have been recognized for that. There was diversity. I think, like I said, I fall into the bucket wherein if someone would have asked me, I would have done the same thing, made a distinction between normal and extended. But fact is, we did see diversity in India. And India's 115 takes away that. It very clearly specifies what is, principles in this regard. So I think that that flexibility, if anybody did take, is totally gone. Extended warranty is a separate performance obligation, and normal warranty would be what you would consider as part of your, the transaction price. I think if you want to add, sir, here, I think, like I said, I initially thought warranty was just clarificatory, but unfortunately, I realized in AS9, the practice there was in diversity. Yeah.
Okay. Let me ask one question from the participants. His question is, you both may take this question. Hi, how revenue will be recognized when goods are given to the distributors to sell? Sale price is 100, customer pays rupees 30, and 70 is claimable as subsidy from government. How the revenue will recognize at the end of the year?
Jana, yours. Take it. I'll take the other one on real estate.
Yeah. I'm just, of course, like you said, I think in the beginning, these are only some thoughts that we're sharing on the spot. And I know it sounds like a caveat, but that's the reality.
Yeah, I know.
Revenue is complex. It is complex. Without getting into details, it's very difficult to answer. Now, this kind of a situation I've seen largely in, maybe fertilizer subsidy and all those things. If you were to ask me in substance, and this is an issue which keeps on getting debated even now, I think if my true revenue, you said 30, my revenue is it's 130 customer pays me and 70
is the sale price, 30 is the customer is paid and 70 is subsidy.
Let's say you can have situation where my cost of production was 70. Now, imagine if I say cost of production 70 and I do revenue only of 30, I would be showing a loss, which is not the reality. The problem which comes here is that one may argue is government your customer. So revenue can only come from contracts with customer. And because government is not your customer, this 70 cannot get into revenue. Okay. Now there, I think I feel Schedule 3 is before this, just before IFRS 15 or India's 115, at least internationally, you had this concept of IS 18. Okay. Now, and we also converged with it, right? IS 18 was still good because there it referred to revenue recognition at fair value. I could have said fair value is 100, but the fair value concept is no longer there. AS 9 doesn't use the word fair value. India's 115 uses the word transaction price, right? And then it also talks about revenue from contracts with customers. So unfortunately, the way I see is if your customer is paying 30 in revenue, you may be from sale of goods, may be able to take only 30. But like I was just saying, the good thing which I've seen in India is Schedule 3 brought in this concept, which is not there globally, of other operating revenue. Okay. So I think I am quite supportive of something like this going into other operating revenue. And other operating revenue also comes under the revenue overall. I think then that can still bring out the right picture to the user. But on a very strict, this thing, it seems you can't take 100 to calling it as revenue
100 can't be taken. Yeah, correct.
Yeah, so I think it's 30, but you take 70 as other operating, and that also comes under the revenue this thing, and then that's how you present it. That's the only way I can think of. But I'm very sympathetic to this issue, and even recently, I can't remember in which group we were discussing this, well, in the institute, that This is an issue. Other operating revenue is the best way.
Yeah.
Hope participants may get the answer.
Alokji, I'm going to take over your responsibility now.
Yeah, please.
I'm going to ask also, this question on revenue recognition from the real estate sector, which is also asked by one of the participants. I think we can spend 2 hours on this only, but yeah, quickly let me just because I think one specific question was asked on revenue recognition only for the real estate sector. Now, as most of us would probably know, what has happened is most of these companies have on the implementation of Ind AS 115, they have moved over from the from the POC method to the completed contract method. Many of the real estate companies have gone over to the completed contract method, which means that they were saying that the performance obligation was only completed at a point in time. So they have changed the revenue recognition model to on a completed contract method. The POC method, they appeared to be saying was no longer applicable for a real estate contract, which they wanted to. Now, there are specific conditions given in Ind AS 115, paragraph 35, which gives specific conditions when performance obligations can be considered to be recognized over a period of time. For example, one could be that the customer enjoys the asset as and when it is being transferred to him. So typically in a real estate contract, it would probably not be possible for us to enjoy the asset as and when the control is being transferred to him, because you probably have to wait for that particular asset to be completed. Only then I get the entitlement for that asset, which is why many of these companies have actually shifted over to this completed contract method. But there is one last paragraph in the same last clause in this paragraph 35, which says that the customer is entitled, or the company is entitled to revenue, to consideration for the performance which he has done till date. This is a specific clause which has been inserted into this paragraph 35. 3 conditions are there. The last condition is that if he is entitled, or for the work he has done, if he is entitled to consideration, or he is entitled to receive money for that particular work done till date, in that case, the POC method can be recognized here. Now, the argument many people have taken is that because there's a cancellation contract in many of these, cancellation clause in many of these contracts, therefore, even the last point also is not applicable. So, therefore, they've all gone by the, what you can call as the completed contract method, which is what has generally, I think, majority of the companies have sort of moved over to this completed contract method. The guidance note, which we spoke about a little bit earlier, the guidance note on real estate transactions, at that point in time, it was applicable for AS. A specific one was given for Ind AS also. But again, after that, we don't have, because we have a very detailed standard, we did not feel the necessity for a continuation of that particular guidance note or further clarity on that particular guidance note. So as we speak today, my response is going to be that, again, I will condition this by saying that it depends upon what contract you've entered into with the customer. That's the first part. Second is that if there is a specific clause which meets this particular requirement of 35 bracket C, which talks about the fact that for the work done till date, you have got a right to receive the payment. In that case, and in that case alone, it is possible that you can probably continue with the POC method. I would also probably go back by what is generally be done in the country. They said that if there's a cancellation contract, in that case, this will not be work because that cancellation contract would go against any of these particular paragraphs there. So that is why these people have gone over to the POC method. So if you want to recognize POC method, your contract will have to be worded very specifically. That's what I'll try to say that. Archana, you can again contribute to this. I would look forward to your views also on this.
I think I understand it's a very complex one, but you've been able to capture it very quickly. I don't have anything to add. But I think on the cancellation bit that you mentioned, if I can just take an example so that some of them may just get that better. I think we did see contracts wherein, let's say, I have booked a flat, right, with the real estate company. And if, let's say, I cancel the flat, one is to, I will just have a forfeiture of 5%, and then I can just move out. Yeah. Now, if you have a forfeiture of only 5%, in a way, one can argue that the real estate company does not really have an enforceable right for the work done. And also, if you look at it in the bigger picture that we were talking about, control includes for that. I mean, we didn't get into what control is, but control includes transfer of risk and rewards. Now, in this case, if you look at it, if the customer can anytime walk out with just a 5% forfeiture, who's really bearing the risk and rewards?
Yeah.
If that property goes down, market value is not picking up, the risk is with the real estate developer only, right? So in that case, if you have a cancellation clause, I think very clearly 35C may not get met. But I just wanted to put that in context. But yeah, if depending on what is the nature of penalty and extent of penalty, etc. But frankly, at least recently, I did see many real estate contracts permitting this forfeiture wherein this customer could just walk out. And that is why we saw many companies moving towards a completed contract. Actually, they should have done that even under the guidance note. But we don't want to get into that because that anyway, risk and rewards, the issue is still the same. Did risk and rewards get transferred? So I think 115 brings in more clarity in that context. Yeah.
Thanks.
Yeah, as we discussed the revenue recognition with respect to real estate sector, Monji, my question is with respect to the joint development agreement. If we take typical example of GDA, the benefits to the landowner can accrue in the form of revenue sharing, or landowner may receive some share of the developed property. Assuming that the landowner is in the business of real estate, how should revenue be accounted in this case?
Again, this is a pretty complex question, Alok. So I'll not. I will only speak about the principles here. There are two principles, basically, what you have mentioned here. One is the revenue sharing arrangement. He's getting a certain portion of the revenue based on that particular contract, based on that particular JDA. And that revenue can, again, come over a period of time. It can obviously be over a period of time. It could be a share in the rentals. It could be a share in the receipts of whatever has been sold and all those things. So that would obviously come under the category of over a period of time, as and when that is being, sort of, again, I'll use the word called right to receive. As and when the right to receive is established for this particular person, I think he will, definitely be able to recognize the revenue. I'm talking about this particular specific case wherein revenue has been, he's got a share in the revenue, shall I say? Share in the revenue. But property, again, the word called control comes into picture here. Again, that control, when is it transferred back to him? I mean, obviously, if he's getting a share in one particular property or a couple of properties or a set of properties in that particular JDA, you would have to be very clear as to see his business being then obviously it would be considered to be inventory for him, right? It could possibly be an inventory for the person, for the real estate person. So I would think that for the second part, wherein he's getting a property, we'll have to fall back upon when the control has been transferred. Again, it will obviously depend upon the completion of that particular project and all those things. According to that, he can probably recognize revenue. But I would put in a word of caution here. Again, the word of caution is going to be that many of these JDA agreements are pretty loosely worded, shall I say. I mean, they're not very specific. They don't talk about this from an Ind AS 115 point of view. They talk about this only from a JDA point of view. Basically, they're trying to say that, okay, Alokji, you got into a JDA with me, this is what you will get. So many of the terms used in 115, which we are talking about, performance obligations, control, all these things may not, and I mean, there's no reason why they should be there in the contract. So I would be a little bit more, clear as to when those performance obligations are being met, and then accordingly decide what is to be done for the revenue recognition. I'll put it in that way.
Okay. Now my next question is to Archanaji with respect to the significant finance component. What do we mean by the significant finance component as per Ind AS 115, and how to recognize revenue in this with respect to the significant finance component?
Archana, you may also want to say how many people are actually doing this.
So I think, again, I would just put it in a very simple conceptual form. A significant financing component is just to find out, is that also one of your performance obligation? In the sense, let's say if I have two customers, one comes and pays me the consideration now, okay? And another one pays me 6 months down the line. Then would I really just think about it as a business person, would you be charging the same price to both? Chances are no. I'm presuming you don't have a normal credit term of 6 months, right? So let's say typically you give 15, 20 days or 30 days credit term. So the minute somebody, if your customer is going to take a longer period, more than your normal credit period to pay you the consideration, chances are you will, which is the substance position would be, you would charge some interest. So all that this is trying to do is that effectively saying that if there is an extended credit period, which means effectively you have not just sold the goods, but you have also given a kind of a financing for that period, right? So please recognize the financing income also from that. That is all it means. Now, typically, yes, you should do it for all transaction, but the standard also recognizes that doing it for every transaction may not be feasible, and therefore it gives you a practical expedient that if it is less than a year, then you need not, because it's all about the cost benefit analysis. But let's say if you've got an extended financing period, then you should separate that as well, because the reality is, yes, you've done two, right? You've sold the goods and you've provided funds. So just separate the two and subject to, like I said, the practical expedient.
Yeah. It is not mentioned in AS9 with respect to the significant finance component. Then
so maybe I didn't speak about AS9. You're right. AS9 as a framework, if you see, the concept of discounting also is not really there. And the AS9 has kept the principles very simple in that context and not really brought in this concept of separating the financing. And this comes in very clearly, you're right, in AS there.
Okay. Mohan sir, would you like to add something with respect to the financing component?
No, it's basically what Archana is saying, nothing in particular. It's just that, I had a perspective as to, and I mean, more than 1 year, definitely yes. The example again, people mention this also as an example of substance over form, because in effect, what he is financing me. Basically, the customer is financing me for, or I received a finance from that customer, because what I pay him now and what is going to happen 2 years down the line, there would be a difference. And that difference is being captured in the form of this particular significant finance component. Now, only for the participants to be, I asked this question specifically because many people come back to us with this question saying that who's going to do this in India? We'll have GST implications, we'll have income tax implications, we'll have multiple problems. How can I recognize this revenue when it's not actually my revenue? Many of these practical scenarios come up. So my response has always been that Ind AS will not answer all your questions from income tax and GST point of view. Those are separate set of laws. You cannot not follow Ind AS because of a GST or an income tax problem. Those are problems we'll have to tackle separately. How do you do it under GST? How do you do it under your income tax and all those things? Will have to be tackled separately. The point I'm trying to make is that we cannot say that there will be problems. Definitely, there will be problems. You will definitely have problems in explaining to the income tax officer that this is not my income. This is only a notional income given by Ind AS 115. So this problem will come up, but you cannot not do it just because of the fact that you've got a problem in some other regulation in India. That's what I wanted to say.
And then there are some exceptions. I'm not getting into it. So, for example, if you have maybe a variable consideration, then how do you look at probably then there will not be any financing component, etc. So there are some exceptions to that. And of course, a question quite often comes up. I actually there was no agreed or let's say intended credit period of financing component when I entered into the transaction, but the customer hasn't really paid as per the agreed period of time. Then what do I do? Do I start calculating? So if it is very clear that when the initial transaction was entered into, the selling price was not, in the sense it did not take into account, or the selling price clearly reflected the transaction price or the promised consideration for the goods, then even though there is a change in the sense that the payment is coming much later than what you really expected it to be, you would not go and start changing the accounting. So effectively the intention is show the cash selling price which you had agreed for that good at the inception of the contract. So if at inception the cash selling price was 100, assuming that the party will pay within, let's say, 2 months, but the party is paying after 6 months, I would still take revenue to be 100 itself, and I would not take,
Yeah. Alokji, just to answer one more thing which came up on the ECL model, Archana's response also is correct. ECL model is Ind AS 109. We should not bring it under Ind AS 115. So you do a separate webinar for that and call Archanaji separately for it.
Yeah.
But just to tell you that it will be based on a provision matrix because it's trade receivable. I think the question has been asked because trade receivable will come under even that will come under the ECL model of 109 only. But just for the purpose of the participant to ask this question, provision matrix based on aging, that will be the best thing which should be done.
And so now that you mentioned receivables, can I maybe take the liberty? I can see we've just got 15 minutes and we'll also have some comments. Since you used the word receivables, I just want to highlight one more big difference in the new standard in Ind AS 115 and the old one is the concept of, I think you alluded to it in the beginning, contract liability. I want to emphasize on contract asset. Okay. Yeah. Now, in the old standard, we had what you call trade receivable. Companies also give unbilled revenue. You know, there is a line item which came as unbilled revenue. Now, while we've moved to Ind AS 115, I still see this unbilled revenue coming separately. So at times I've seen a company showing contract asset, trade receivables, and unbilled revenue. Yeah, all three. So the point I wanted to make is that under Ind AS 115, when you've got something from the customer, it is either a receivable or a contract asset. There is no third category. You can no longer have a line item called unbilled revenue. Yes, this unbilled revenue can come as part of contract asset, but something which is separate from contract asset and receivable being presented as unbilled revenue is not, the standard doesn't envisage that. And for those who do not really know the difference between the two, because for some reason I've seen many have missed this bit. Absolutely. So trade receivable is, let's say when you build something to your customer, trade receivable is something that you have a right, and I'm again not using exact language from the standard, so trade receivable is what I'm entitled to get just by passage of time, even if I don't do anything else. So I've done my work, I have billed the customer. Let's say I have said I provide maintenance services, monthly maintenance services. So my March maintenance services, I billed you on 31st of March. And then you have 15 days in April to pay me for it. So you pay my bill every 15 days or whatever. Now, even if I don't provide you any services in April, even if my contract comes to an end on 31st of March, just by the virtue of 15 days lapsing, you're supposed to pay me my money. That is trade receivable. What is contract asset? Contract asset is where, in addition to time lapsing, there is something more I need to do to get the work. So it's a little complex because on one side, I'm saying this is earned, but on one side, it is not. I can't recognize this as trade receivable. So let's say that I am I'm just thinking of a good example. I'm developing a software which has certain milestones, okay? And I do my billing basis the milestone. So let's say that, let me not even get into the billing. So let's say I have to complete certain milestones. So I meet a milestone, and let's say in a way, I have done my work for that particular module. But I have agreed with the customer that for this work completed, work is done, I will bill you, but you will pay me only when I do 20% of my next module, for example. Okay. Then in that case, even though your work is completed, it's not that this is your revenue is not earned, you've not completed your performance obligation, you've not done your promise or fulfilled your promise. I've done. But for whatever reason, contractually, I have linked it to something to be done in the future, my right to seek recovery that I have linked. Okay. Then it becomes like a contract asset. So let's say for whatever reason, if my maintenance services, had I said that I will, instead of 15 days later, I will bill to you only when my next month's services are complete. So it doesn't mean I didn't provide services, maintenance services in March. I did. Just that for recovery purposes, I said I will bill it only when the next step is completed. Now there, apart from just waiting for the time to go, I also need to do something more. And that becomes a contract asset. Sorry, I can't think of a better example. If you can just think of a better example of a contract asset.
That's absolutely right. Yeah. But Alok, I'll just add on to one thing.
Yes, please.
It's very critical. Nice that Archana brought this up. You look at this disclosure requirement in Schedule 3, the trade receivables aging. They're saying unbilled revenue will be disclosed separately. There's also a separate small line item which is given at the bottom. It says that unbilled revenue will be should be shown separately. So many people are thinking that unless I got unbilled revenue in my balance sheet, I should not show this. Actually, it is not correct. As Archanaji rightly pointed out, it could be contract asset which has to be shown separately.
Yeah.
Just because they have
I
said
think
that
the guidance not clarifies. The
guidance
guidance
not
not
clarifies.
clarifies
Yeah.
it. But unfortunately, in practice, there is a tendency to just do what was being done earlier. Wherever they had this line of unbilled revenue, it's coming. Now, why is this? I'm not a FI expert, but why is this issue coming up? The next question which comes up is this contract asset? Is this a financial? I mean, is it a financial asset or is it a non-financial asset? And I think that also gets clarified. Initially, when the standard came, there was a lot of debate around it. So I think now we've concluded it is not a financial asset. And in terms of where it gets presented, so I just wanted to say that unbilled revenue, let's say unbilled revenue means I have done my work, I've not billed. If you feel you've not billed only because, like I said, I may provide maintenance services, but I may agree I will bill you on the 15th of the next month. If only passage of time is required, please take this unbilled revenue to receivables.
Yes.
But if you've linked it to something else, then please take it to contract asset. Don't have three items. There is no such this thing. So just wanted to highlight that. Yeah.
Okay. Due to paucity of the time, I will just take 2-3 questions of the participants. Then we'll move on to the interplay between the income tax, GST, and the AS. And last is the disclosure part. Now, my first question from the participants is for IT-based company with a reimbursement of seating capacity caused by customer can be considered as revenue. The reimbursement of the cost recovered from the customer, that is for IT-based company with a reimbursement of seating capacity cost.
So it's like saying I had given someone 100, I had allocated 100 seats, they don't use it, and even then I get it, right?
Yes. Yes.
Why I would be very careful in calling it reimbursement. Why are we calling it? Isn't it wouldn't there be a normal charge out rate? Let's say you'll still get paid. It's like saying use it or don't use it, but still pay me, right?
Also, reimbursed by whom is the question? Who will reimburse this?
Yeah, it is the question from the participant itself. They just want to ask whether the sitting capacity cost which they have incurred, because I think they are not completed the contract from the customer end, because the customer is not going to fulfill the contract terms, and then they want to reimburse only the sitting cost from the customer. In that case, it would be the revenue, or it would be the reimbursement of the cost if there is no markup, like you said in the case of shipping. And
I'm not frankly very clear, I'll be honest. I haven't understood. And even if this is, let's say, one could be to say, because you now also mentioned I've not been able to provide services, etc. Is this ultimately what you're getting under the contract? It could be a penal amount or whatever. It's if the other party is not able to perform. I'm not very frankly clear on the transaction. If it is something, it is, one could be to say this is the minimum amount you will pay to me irrespective. Okay. If this is the minimum amount you're getting irrespective of whether utilization happens, then it's still revenue. But I am not really sure. I'm not sure I've understood the transaction, frankly.
So maybe we just require further details around this. We're not sure what it is.
Okay. So now I will move on to the interplay of accounting standards with income tax and GST provisions.
Very simple, no interpreter. Forget. Question is over.
Yeah, so but there is some issue with the practical issue. Some contracts with the governments are the inclusive of the GST. We're supposed to book the revenue inclusive of the GST. Whether the GST component is to be reduced from the revenue itself, or it should be debited to profit and loss account.
See, I think there's a specific paragraph in 115 which says that revenue excludes certain sales taxes. Okay, I think it's some para 45 or 47 it is. It says that the revenue is exclusive of sales taxes. Now, okay, we are calling the sales taxes as GST in India, so I would believe that it should definitely not be a part of the revenue. Also, I think if you go back to what we spoke about earlier, Alokji, about this fact that revenue is what is earned in the normal ordinary activities, income arising from the ordinary activities. Actually, GST is not income at all. It's just, I'm a pass-through. I'm just collecting and paying it to the government. That's all. So definitely GST will not be a part of revenue. How to do it? You should do a back calculation and remove the GST component and show the gross amount as revenue and the other amount will be as GST collected, paid, whatever. That's how it will be here.
Okay.
So you have to do a reverse calculation saying that, okay, 82 is my sale, 18 rupees is my GST, 100 rupees is total amount. But definitely GST cannot be a part of revenue, even though the contract is inclusive of GST.
Okay. Instead of debiting to profit and loss account, we have to debit to the revenue itself, if it is the inclusive.
Yeah.
Now, my second question is with respect to the ICDS. Sir, as per the ICDS, revenue from service contracts with duration of not more than 90 days may be recognized when the rendering of services under that contract is completed. Let's say the contract is for the less than 90 days. Then, as per the ICDS, it should be recognized after completing the contract. Is there any specific condition in accounting standard or Ind AS with respect to the duration of the contract?
90 days is definitely not there. There's definitely no concept of 90 days or 3 months in the standards here. But again, if you look at it from the point of view, Ind AS, I think Ind AS is very clear, as Archana ji also we've been discussing for the last 1.5 hours or 2 hours almost now. See, it's either performance obligation at a point in time or over a period of time. For over a period of time, in fact, the standard goes by negative definition. It says that if those conditions in paragraph 35 have been met, it is over a period of time. Otherwise, it's at the point in time. So at a point in time is actually a negative definition in Ind AS 115. I will first have to check whether it is over a period of time. If the answer is no, then it is at a point in time, right? So, but specifically 90 days, the only condition, again, practical expedient, as Archana ji mentioned, was that if it is more than 1 year, I will discount it to present value. That's all. I'll have to do a discounting. That's all. Apart from that, no specific guidance which I know. Similar, I think in AS, of course, there's even more little guidance in this.
I agree.
Okay. Now, I will move on to the next question. It's with respect to the presentation and disclosures. If we say what are the presentation and disclosure requirement under the respective standards, it's very large, and so I just discuss 2-3 important points to Archana ji. What are the key disclosures for the contract balances?
Oh, okay. I don't remember it like that for contract balances, I'll be honest. There's a very exhaustive list of disclosures under Ind AS 115. I don't think, other than just separate presentation, I frankly don't recollect what additionally needs to be given. I'm really sorry on that, but that we can check. But as we're on disclosures, I think I wanted to highlight that contract asset has to be disclosed separately. I mean, there is this concept which has come in. And I think from a disclosure perspective, I also wanted to highlight, the fact that there's all your significant judgment estimates, etc., require very specific disclosures. And one more bit I think that we were discussing is on the disaggregated one, which is very important. And it led to a lot of, discussion when the standard was being finalized. Let's say I have a contract, which is a 3-year contract. Okay. So I've fulfilled some performance obligations. There are some remaining performance obligations. Obviously, it's a 3-year. I've done something in year 1, 2, and 3 still pending. The standard says you've got to, there are very specific disclosures it requires you to make for the remaining performance obligations. Now, there is a practical expedient, but that is only if the overall contract period was 1 year. So let's say it's the overall contract period of 1 year, but I started in Jan. So by the time I end my year in March, I still have another 9 months. There probably you may not be required. But if it's a long-term contract, you need to give, a lot of details about remaining performance obligation. In one way, it is important. I'll tell you why. Because if I'm a stakeholder, it is important for me to know what all contracts the company is committed to. Yes, it'll get revenue, but in a way, it tells me their, contracts are there. But then if you look at it from a company perspective, it's a very sensitive disclosure. One, because it is sensitive, commercially sensitive. Second is that it doesn't really give you a full picture, because a reader may just look at those remaining performance obligation and think this is my next year income. But that's only committed contract. I may enter into new contracts and so on. So on one side, it doesn't really give you the full picture of the business. But yes, there is merit in terms of getting some idea as to contracts where the company is committed. I think, I would actually put focus more on these kind of disclosures which have come in. They're very detailed disclosures, like I said, specifically around the estimates and judgments, etc., which we need to look at. Yeah.
Alok ji, if I may just add one part, this is, I know you're running out of time, but we'll have to expect Chairman ASB also to give his views and tell us what he feels about this. There's one thing I think you have covered pretty much all the aspects of 115 pretty much in detail. And the only one thing which I think we left out was this contract costs, which can be capitalized. I think that's something which we forgot in this.
I think I alluded to it in the beginning, thinking we'll have time, but we
didn't have a specific thing on that. And because this came in from a disclosure perspective, I thought I should tell participants this also. There is a specific clause in 115 which says that contract costs which can be recoverable from the customer, and they give an example of sales commission, can be shown as a contract asset and amortized over the term of that when they're expected to get the benefits. So this is again a separate disclosure requirement will have to come for this. So this is something which we had not covered in this thing. So I thought I should probably
and this is very important because earlier it was only under construction contract that you could do this.
Exactly.
Yeah, and while there you could defer these costs, here you couldn't. Now it brings parity by virtue of single model. Yeah, and since we're talking about disclosures, last 30 seconds, Chairman, is, we've got detailed disclosures, we've got performance over a period, then many related disclosures of that. Let's say we spoke about, variable consideration using expected value method, etc. So how you've done that, very, very extensive disclosure. Just think about transaction price, how was it determined and so on. So think about any element that we discussed today, there are related disclosure requirements. Yeah. Yeah,
so that's what we want to say. Thank you.
Okay, thank you to both the panelists for enlightening us for all the detailed questions been asked and give us the practical inputs for all of the points. Thank you once again. And one more thing I want to ask, if possible. Please comment in 30 seconds time if possible. As an auditor, how should we take comfort on such estimates, judgments and assumptions?
30 seconds, you want me to answer that question, is it?
Yeah, please, sir. Actually, because of paucity of times only, sir.
I'll tell you, put it as a key audit matter. Problem solved.
There's no shortcut. I think professional skepticism. No shortcut. Exercise professional skepticism. I know it sounds very cliched, but that's the reality.
Yeah.
Okay. Thank you very much. Thank you very much, everyone. In fact, this topic is so huge, and we have got nearly 50 questions, and could not take many questions out of it. I suppose we should have another session on this. One of the key, very, very key pain point or discussion point is principal agency relationship.
We didn't discuss that.
So that itself could take few hours just for the initial discussion. But yes, excellent discussions today, and I thank Mohan Laviji and Archana Bhutani ji for excellent deliberation, and also I thank Alok Deora ji for excellently moderating and keeping the session very, very much alive and interesting. Also, I thank C. Shalini Jindal ji, the convener for this, all our India's programs, or I would say educational programs. It could be whether the India certificate course or webinars or whatever. She and Kulashekar ji, they are both doing it. And of course, thanks to all the participants for joining in good numbers and asking so many questions. And again, putting before my regrets that due to paucity of time, we could not take around 50 questions are there, but we could not take only one or two could be taken by the moderator Alokji. Let's hope we can take it at some other time. And thank you each and everyone. Thank you very much.
Thank you. Thank you.